Hello and welcome to the next of our full course lectures. Don't forget you can download all of our mind maps shown here for free on our website www.mapitaccountancy.com. We're now at a position where we can start to look at the financial statements, and we're going to start with sole trader financial statements. We'll then move on later on to look at a limited company financial statements, which are a little bit more complex. But we're really just looking at the basics here. We're starting to understand what the financial statements are and how transactions will affect those financial statements, and also some of the concepts that we have around the financial statements. So for a sole trader, there's really just two main elements to a set of financial statements or a set of accounts. Those will be the income statement. This used to be called the profit and loss account. So income statement, well, what does that do? The income statement shows us the profit over a period of time. So it shows us what the business did over a period of time. Now, that's usually 1 year, but not always. We could have an income statement for 6 months or 3 months or any period of time, but generally we will show the performance through the income statement for 1 year. So it shows the sales in the year, it shows the costs, and ultimately shows the profit over that period of time. So think of the income statement as an analysis of performance over a period of time, as opposed to the statement of financial position, or balance sheet as this used to be called. Now, the statement of financial position simply shows us the position of the business at any point in time. Think of this as a snapshot of the business, particularly the assets and liabilities owned by the business. So it's not an assessment of performance over a period of time. The statement of financial position is a snapshot of where the business is at that period of time. So the income statement shows performance. The statement of financial position shows the position at this point in time. So that's the difference between the two. One is showing us that performance over a period of time. The other is saying, right, where are we right now? So what's the format for these different elements? Well, the income statement will look something like this. So we have the sales revenue at the top. We then have what has gone in to make up the cost of sales. So that's really the purchases we have. However, remember, we have some opening inventory. So it will be added in because we probably have sold that opening inventory. Plus then we'll have made purchases in the year, which we sold as well. However, not all of them will be sold, so we'll have closing inventory. So there we're trying to match up the inventory that was actually sold to get that sales revenue. So it's opening inventory plus purchases less closing inventory gives us the cost of sales. Sales revenue less the cost of sales gives us gross profit. And we'll be looking at all of these in more detail later. We're really just looking at the format at this point. We then take out any other expenses. So think of cost of sales as being directly attributable to getting that sales revenue. So that's the actual goods that we had to buy to sell on. The rest of the expenses go down towards the bottom, like wages, rent, sundry expenses. Those are more difficult to allocate, so we just group them together over the year at the bottom. Taking those off then gives us our net profit for the year. So the income statement, remember, assesses the performance over that period of time, usually 1 year. So looking at the sales, less all of the expenses, giving us the profit, how we did in that period of time. As opposed to the statement of financial position. Now this, on the other hand, is the position of the business at a point in time. So at the top we can see the non-current assets like property, plant and equipment. Well, that's telling us what the value of those is at that point in time. The current assets will be things that are more liquid. Again, we'll talk about these in more detail later. So inventory, receivables and cash. Those, what do we have at this point in time? What are they valued at? Adding those all together will get us our total assets. So our total assets will equal our total capital and liabilities added together. So to get the total capital, first of all, we take last year's capital, and this is the excess profit that's still in the business that's owned by the sole trader. So it's brought forward from last year plus any profit that they made in the year, less any drawings, which is taking out some of the profit. So that will say what capital remains in the business. So that's capital that's been invested or has been increased by profit from that sole trader. Add on then the liabilities, which will be like loans and then payables. That will get us our total capital plus liabilities. And our total capital and liabilities will equal our total assets. And that's an important concept that we will return to when we start to look at the nuts and bolts of putting together a set of financial statements. So that's the format of each of those elements. The income statement giving us the performance of the business over a period of time. Then the statement of financial position telling us what at this point in time the business owns and is owed. So we then have to deal with various transactions during the year. So those transactions will always have at least two effects. Now, usually what will happen is that the effect on the statement of financial position will then be duplicated on the income statement. So usually there'll be two effects, one affecting the statement of financial position and one affecting the income statement. For example, let's say that the business sells some goods. So as I've mentioned, each thing that we do during the year will have two effects. Now in this case, we'll have an effect on the statement of financial position through selling the goods. First of all, our inventory will go down because we've sold those goods. So we've sold the goods, the inventory will go down by the amount that those goods cost us because they're no longer in inventory. Also, our cash will go up by the amount that we sold those goods for. So the inventory will go down, our cash will go up. On the income statement, well, we'll show the sale because remember, the statement of financial position shows us the position of the business. We've now got less inventory and more cash. The income statement shows us what performance has been. So we need to say, well, look, we sold some here. So here's the amount of the sale. And we also need to show that cost of sales. So that will be shown by that movement on the inventory. So as you can see, there's an effect both on the statement of financial position and on the income statement. The movement on the statement of financial position changes the position of the business. The movement on the income statement shows us the performance and how it's been affected by that transaction. When it comes to purchasing goods, for example, on the statement of financial position, inventory will go up because we purchased some more goods. Cash will go down because we bought some goods. Or we create a payable if we didn't actually pay for them up front. So what I'm trying to do here is give you an idea of the transactions that we're going to deal with. We're going to start thinking about how they will affect our financial statements. In the next lecture, we'll go on to formalize that. We'll say, right, how do we actually do the transactions? And that will be in the form of debits and credits. So we can already see that there's two effects from each thing that we're doing. And those will be the debits and credits that we will look at later. So when it comes to the income statement for purchasing goods, well, we'll have to show that purchase on the income statement because that's the movement in the year that we'll be interested in showing. Let's say that we paid an expense, which is another aspect. Well, on the statement of financial position, our cash would go down. On the income statement, we'd have to show that expense because it would affect performance in the year. It would reduce our profit. So you can see again, we have an effect on the income statement and we have an effect on the statement of financial position. When we're purchasing an asset, now this one won't affect the income statement. It will be for our statement of financial position, we create a new asset and our cash will go down. So you can see, although it only affects the statement of financial position, there's still two aspects to it. Assets will go up, cash will go down. When it comes to introducing capital, well, on the statement of financial position, again, we'll increase the capital and increase the cash. So cash will go up because it's been introduced. The capital will go up because the business has more capital to deal with. So again, we can see that there are two effects. And the last one I want to mention is when we withdraw funds from the business as the owner. Well, if the owner withdraws funds, that's not an expense because it's just a withdrawal of profit. So in that instance, what will happen is on the statement of financial position, we will decrease the capital and decrease cash. It doesn't affect the income statement because, as I said, it's a drawing of profit. So it's not an expense, it's a drawing of profit. So this is just to get us to start thinking about what business transactions we'll have to deal with and what effect they're likely to have on the income statement and the statement of financial position. Let's put some numbers to it. Let's look at illustration 1 and work through it. So we're given some financial statements, then we're given some business transactions, and I want to look here at what effect those business transactions will have on the income statement and statement of financial position. Again, we'll formalise this in more detail later when we start to look at how to actually record them. But we're just thinking here generally about the effect that each of those transactions will have on our financial statements. So let's work through that together. In illustration 1, we have Jim, who owns a very small business that he runs as a sole trader, and he has the following financial statements at the minute. We then have some other transactions that have occurred. So we're just really thinking here, how will these transactions affect the position and results of the business? So we're going to think to ourselves, what do these transactions do? And then I'll show you how they would affect the financial statements. Now, this is not for the detailed recording. We'll do that in the next session. We just want to start to get an idea of how these financial statements are affected by each item that we're looking at. So note 1, first of all. Goods that were originally purchased for $40 were sold for $50. So how will that affect us? Well, the inventory had cost $40, so that's no longer in inventory. So we'll need to remove that from the inventory. So inventory will go down by $40. That $40 will also increase our cost of sales on the income statement because we've now sold them. They'll be included in our income statement in cost of sales. Don't forget the cash received of $50 must increase the amount of cash also. So we received cash of $50. That will increase the amount of cash that we have within the business. And of course, we need to record that sale of $50. So we'll need to show that as a sale on our income statement. So for note 1, all of that will happen because we've sold goods that were purchased for $40. We need to reduce our inventory, increase our cost of sales, increase our cash, and show that sale of $50 on our income statement. So you can see how a lot of these areas are interlinked. In note 2, we're told that more goods were purchased at a cost of $30. So we've purchased more goods. What will that affect? Well, we have to get those into inventory. Our inventory will go up by $30. Also, the cash paid will be shown in cash. That will reduce the amount of cash that we have in the business. So again, we can see that interlinkage of two areas being affected by that purchase of the goods. In note 3, well, rent was paid at a cost of $15. So we paid rent. What will that affect? Well, it's an expense, so we will show that expense in our income statement. So we show the $15 in the income statement, but don't forget, we also paid it in cash. So we need to reduce our cash by $15 on our statement of financial position. So again, we can see that there are two effects, both the expense to be recorded in the income statement, and then we have the $15 cash reduced on our statement of financial position. For note 4, we bought a non-current asset for $10. That purchase of an asset will increase assets by $10, but of course we paid cash, so it will reduce cash by $10 also. For note 5, capital of $20 was introduced by Jim. So note 5, capital introduced will increase cash by $20 and also increase our capital introduced by $20. So we'll have more capital in the business and more cash within the business. And lastly, note 6, the drawings of $5. So Jim took $5 of drawing from the business. We'll talk in a bit more detail about exactly what drawings are later on. But at this stage, we'll understand that that decreases our capital. Really, it's drawing out profit from the business. So Jim has taken out $5 of his profit from the business. So that will reduce the capital and also reduce our cash. Now we'll look later on at exactly how to record those transactions, but that's broadly speaking what will happen. And we need to understand at this point that these business transactions have more than one effect in our financial statements. Usually we'll have to record it in the income statement and the statement of financial position. But sometimes, as with a purchase of an asset, it will affect just the statement of financial position, but it will always affect two areas of it. So what effect would that have on Jim's financial statements? Well, for his statement of financial position, for his assets, he started off with 300. We added 10 in because he bought a new asset in note 4, taking it up to 310. For inventory, well, he sold some inventory and he bought some. So it was less 40 plus 30. So that leaves us with 140. And the cash of 50, well, there was a lot of things happened with cash. We received 50 for the sale. We purchased a $30 worth of goods. We paid rent of 15. We also had non-current asset purchased for 10. Jim introduced 20 and then took 5 out. All of that will affect cash to bring it to 60. So the total assets have gone from 500 to 510. Looking at the capital, well, the same amount is brought forward. We add in the profit from the income statement, which we'll look at in a second. It's 25. Then the capital introduced, well, Jim had 20 introduced, so that was note 5, so that will increase his capital. Less the drawings of 5, so he had 5 in note 6, bringing drawings to 75, and that gives us our total capital of 510. So you can see that our assets equal our capital. We don't have any other liabilities, because our assets would usually equal our capital plus our liabilities, thinking back to the format of our statement of financial position, and that balances it off. Now again, we're just thinking generally here about how this will affect our statement of financial position. For our income statement, well, we had sales of 500, we sold 50 more, bringing it up to 550. Cost of sales will go down by 40 because of the goods that we sold. And our gross profit, therefore, will be 210. So we sold goods for 50, they cost us 40, that takes our gross profit up by 10. Expenses, well, we've an extra 15 to reduce our profit there, so it goes from 30 to 25. So profit has gone from 30 to 25. So here we can see the effect that these various transactions will have. They'll affect both our income statement and our statement of financial position. So we always have two effects to the transactions, and we'll look in the next lecture in how we go about recording those in detail using debits and credits. So now we understand the effect that business transactions will have on our financial statements. We will go on to look in more detail at how to record those transactions, but we now understand that there are two effects for everything we do, and we need to think about how those statements are affected. The other thing we need to be aware of are accounting concepts. Now, from the point of view of the exam, this is more likely to come up as a definition that you simply need to know and be able to regurgitate, be able to tell the examiner or point out of a multiple choice question. So first of all, business entities. Remember that for a business entity concept, we need to keep the business separate from its owner's personal activities. So we're looking at sole trader financial statements here, and the business entity concept says that, look, even though the sole trader is a person, their personal expenses need to be kept separate from the business. If the owner, for example, paid personal expenses out of the business bank account, that would be counted as drawings, not an expense of the business. So the only expenses we will include in our income statement, for example, are legitimate business expenses, not the owner's personal expenses. So the business entity concept is that we keep the business transactions separate from the owner's personal activities. The income statement. Well, remember that the income statement is the performance in the year. And one of the key concepts that we're going to learn about here is that it's prepared on the accruals basis. Now, what does the accruals basis mean? Well, the accruals basis means that we record the income and expenses when they occur. So let's say, for example, we sold some goods on the last day of our accounting period, but we didn't receive the money until the following week. The question here is, should that sale be recorded in the year when we made it, or should we record the sale in the year when we received the money? The accruals concept says that we record the sale when it occurs. So we would record it in the current year, even though we didn't receive the money until the following year. So that's the accruals concept. We record that now, it would be recorded as a sale, and it would be recorded as a receivable in our statement of financial position. And then we would receive that money in the next financial year. So we don't record the sale when the cash is received, we record it when it actually occurs. That means we're going to have things like receivables, we're going to have payables, and they will remain until the cash is actually received. So we're going to look in a great deal of detail at this accruals basis and see how it will affect our statements. Remember I mentioned drawings? Well, drawings are not wages. Drawings are drawings on profit. Really think of this as being the owner taking profit in advance. So if the owner has taken money out of the business during the year, really what they're doing is drawing out some of the profit early. So it's not wages. The owner takes that profit in advance. Now that could get confusing because it may be that the owner also gets paid wages. So they may get paid wages, which is a set amount each month that then is declared as a wage and income tax is paid on it. But if it's drawings, the owner will take that as a profit in advance. So we need to be careful about how we treat that, and we're going to look in detail at how to treat drawings later. But think of it as drawings of profit. Often these accounting concepts are actually shortened. So drawings means drawings of profit. So think of it always as drawings of profit. Also then, the accounting equation that I mentioned was important. This is based on the statement of financial position, and you need to learn this. This is very, very important. The statement of financial position, remember, must always balance. And the formats of the accounting equation are that either you could say that your assets equals your capital plus your liabilities. Well, we know that because when we looked at the format of our statement of financial position, our assets up at the top equaled our capital plus our liabilities at the bottom. But you could also turn it around a little bit and say assets less the liabilities equals the capital. So sometimes the examiner will play around with that accounting equation and see, do you know it well enough to move it around a little bit and see what holds true. So these are two formats that I would learn and make sure you know. The assets of the business are equal to the capital of the business plus the liabilities. And the capital of the business, remember, is any capital that's been introduced plus any profit that's been made, less any drawings of profit. So make sure that you know and understand that statement of financial position accounting equation, because it can come up quite often. Lastly, when it comes to some definitions, things that you need to be able to define in the exam, again, these are things that you need to learn. They're easy marks if you know them, but difficult marks if you don't. So simply learn these definitions. An asset is a resource controlled by the entity from which future economic benefit is expected to flow to the entity. A resource controlled by the entity from which future economic benefit is expected to flow. Think of a piece of plant that the business has. Well, it's controlled by the entity because they own it and they decide what to do with it. Future economic benefit is expected to flow from it because it's going to produce goods for us. Those goods then are going to be sold for cash, and that is going to flow into the entity. So when you're thinking about these definitions for an asset, think of an asset. Think what it is and how it affects the business, and that can lead you to the definition. So a resource controlled by the entity from which future economic benefit is expected to flow to that entity. As opposed to a liability, which is really the opposite. It's a present obligation as a result of a past event, which results in an outflow of economic benefit. For example, let's say that we bought some goods, but we haven't yet paid for them. Well, we have a present obligation as a result of buying those goods, and we expect it to result in an outflow of economic benefit because we have to pay for those goods. So the obligation was buying them, the past event was buying them, and the outflow of economic benefit will occur when we pay for them. So again, that leads you to that definition of a liability. Lastly, the equity of the business. Well, this is really when we're looking at limited company accounts, and it's the same as capital for a sole trader. It's the assets less liabilities. So remember, the assets equals the liabilities plus the capital. Well, if the equity is the same as the capital, well then the assets will equal the liabilities plus the equity. So it's the same as capital for a sole trader. Equity is really what we call capital in a limited company. So there we have an introduction to sole trader financial statements. So we now know the different elements that are within it. The income statement and statement of financial position. Remember, the income statement tells us the performance over a period of time. The statement of financial position is a snapshot of the business, its assets, liabilities, and capital. We also now know that business transactions will need to be recorded in the year. We know they will affect the income statement and the statement of financial position, although there are a few that just affect the statement of financial position. And we now know concepts. Now those concepts are crucially important. You need to learn each of them. You need to know the business entity concept, the accruals concept, the drawings concept, i.e. the drawings are drawings of profit. You need to learn the accounting equation and know the definitions of an asset, liability and equity. So all of this is very important, primarily because it's easy marks if you know it, but you need to come back to it and understand it. So once you've finished this, have a go at the test your understanding questions at the end of the chapter, work through them, see how many you get right, and if there are a few that you don't, go back and make sure you understand why not.